I should say
I'll find it.
one thing I would like to announce, and people who took the summer school probably know about that. So we have an online reading group every Thursday, first Thursday of the month, which got after work with Rob here, Andre organizing. If you want to be part of it, you're welcome to be part of it. And it's typically students presenting and our favorite paper they have, or the assignment. It's in that space, continuous study. And we have also a LinkedIn group, so probably can join this LinkedIn group. Somebody told me yesterday, or Witchy will probably organize that for you guys, if you want to. Yeah. Okay, so the next speaker is Aleksei, and Aleksei will talk about value at risk constraints. And he has a very special device.
Hi everyone. Yes, I have a very special device here. So it just means it's gonna take me some time to figure out how to use it. So I'm gonna talk about this value at risk constraint, robustness, and aggregation paper. I'm gonna talk about value at risk constraints as a device to simplify macrofinance models. The robustness part is a micro foundation for this constraint. I'm not gonna talk about it today because it's a bit more technical, takes more time. And then the main purpose of the talk is gonna be to tell you how to set up a macrofinance model in a simple way that allows for aggregation, keeps things tractable, and allows you to analyze risk premia. So this is one of the main objectives of the macrofinance literature. We want to model the macroeconomy with financial shocks and with volatile risk premia. So risk premia themselves are an endogenous object. It's a price, right? We might not necessarily care about the price, but something is driving this price, and this something might be driving the economy as a whole. We care about that something. So this has been challenging to do for a variety of technical reasons so far. I'm going to here offer a way to simplify those macrofinance models and give you some insights about aggregation in environments with potentially rich financial shocks. So what I'm going to do specifically is I'm going to tell you about how to model a macroeconomy with a portfolio constraint that gives you three nice things together. The first thing is it allows for a fully dynamic model where agents are long-lived, so they can take non-trivial consumption savings decisions. And this is important because you want to endogenize the interest rates in your economy. Second, this economy keeps portfolio choice very simple. Portfolios look myopic, as if investors are not actually long-lived, and they just look at what happens today and tomorrow. Those portfolios are going to be tractable, and they're going to be very easy to aggregate. This is the third nice thing. While we can still have time-varying risk tolerance of agents and time-varying risk tolerance of the market as a whole. So these three things together is what I'm going to be talking about today. Now, just to contrast this a bit to existing approaches, or to place this within the existing approaches, there are usually, I would say, two ways to get volatile risk premia in equilibrium of these macrofinance models. One of them is you shock agents' preferences for risk or for uncertainty in general, right? You can shock the risk aversion parameters, you can give them robustness concerns, you can make their risk aversion co-move with aggregate states by introducing some habit-like devices. Or you can induce volatility in risk premia by redistributing wealth between agents with different preferences for risk, right? Like in the Marcus model, for example, you redistribute wealth between specialists. They have one capacity to handle risk, and like regular people who have a different capacity to handle risky assets. So this model is going to allow for a bit of both by shutting down some potentially important, empirically important channels, but I'm going to be able to do both here. And I'm going to try to show you how these two things are different. Okay. Now the technical sort of advantage of what I'm going to be doing is this. I want a smaller state space, and I want to minimize the number of PDEs to solve, right? I want to maximize the speed of solving the model. So this is going to be convenient. Okay, so what I'm going to do is I'm going to set up the constraint. Then I'm not going to talk about the foundation through robustness concerns, only maybe if I finish the talk in 50 minutes and then I have 10 more minutes, likely. Okay, and then I'm going to talk about aggregation results, specifically this nice thing, we're able to endogenize interest rates. We can look at what happens to risk premium, and then we can analyze redistribution in this model too. And then I'm going to show you two small, really small and simple applications. This talk is going to be like orders of magnitude less technical than maybe the previous talk. Okay, so the existing literature on this value at risk constraints is kind of large. It comes from both finance, recently from some macroeconomics, in particular international macro, but also there's a large literature in mathematical finance where people deal with all those types of constraints. This slide is just here to show you that there are different strands of literature. I'm not going to go through them, but it's useful to look at some of those, and I'll bring some of those up later. Okay, so let's start with the constraint. So this is the setup. I'm going to first set up portfolio choice of agents individually, and then I'm going to talk about aggregation separately. So what's going to be the setup? We have underlying shocks that drive the economy. This is a d-dimensional shock. The important thing here, and it's an important constraint on the model, they have to be Brownian so far, right? I'm not relaxing this so far. So this rules out a lot of potentially interesting things, like you cannot have aggregate payout events if you have an economy with bonds. You cannot have jump risk. You cannot have disasters that are aggregate disasters and not individual level disasters. Some of those things could be relaxed, but I'm going to show you the simplest version here. Now, the second important thing is that, so there's this aggregate state X that is evolving like a bunch of Brownian motions. The aggregate excess returns are also going to be Brownian. So they're also going to load on the same underlying shocks that drive X. And the drift and volatility, the drift and the loadings of those excess returns are going to be endogenous, determined in equilibrium. What's important is there's no jump term here. Okay. So there are risky assets, and there's a risk-free asset. This is typically going to be in zero not supply. What is this risk-free asset? Is an instant maturity bond that pays you interest rate, R, which is potentially also endogenous. Not potentially, we want this to be endogenous, and it depends on the aggregate state X. So K risky assets, one risk-free asset. Before we talk about other agents, let's just fix one agent and let's look at their budget constraint. So the budget constraint looks like this. Because there's just K risky assets, you stock the excess returns on those risky assets here. They choose portfolio shares theta, it's a vector on each of those risky assets, and then the residual position is in risk-free here. So you get the interest rate on your wealth, and you consume out of your wealth. So far, let's keep the budget constraint this simple. So theta is a vector of portfolio shares on risky assets, doesn't sum to 1, right? Can sum to something more than 1 if you are levered up and you borrow in risk-free. Can sum to something less than 1 if you also decide to invest a positive amount in risk-free. Okay, what's the agent's problem? So the agent's problem is they're a simple log utility agent. Here, there's log utility of consumption. The key part of the model is they face this mean variance looking value at risk constraint. So this is a portfolio constraint that says the variance of your excess returns over the next increment of time cannot exceed a multiple of your expected profits from the same portfolio over the next increment of time.
Why do you have a rho multiplied in the utility function? Like discount is already like e to the power minus.
This is just to make the value function log of wealth plus something instead of 1 divided by rho log of wealth. This is just a normalization. This rho is going to come out either here or in the value function. I choose to put it here. It's a constant. Doesn't matter.
The X state is Markov and stationary.
Is Markov is not stationary?
Oh, it doesn't have to be stationary?
No, unfortunately, or fortunately not. No. But it's like super Markov. That's true. Okay. Basically, it's a big part of the game trying to make this stationary. So I'm going to talk about this as well. Okay. So side note. So I'm calling this value at risk. You might be surprised, right? It doesn't look like value at risk. It looks like a mean variance constraint. Why? Well, there's a heuristic explanation. So in continuous time, when we say heuristic explanation, I think we mostly mean let's do some math thinking that this dt is a very short time increment instead of a notation for taking the limit. So let's do a bit of that. So suppose there's some allowable level of losses, L, and some allowable probability to incur this level of losses or more that is called alpha. So a constraint that tells you you cannot expect to incur more than L of losses with the probability alpha is here, right? This is your returns, excess returns on your portfolio. They cannot go below this level with a probability that is higher than alpha. So this would be a typical value at risk constraint. At least in discrete time, we would set it something like this way. Of course, there's going to be wealth here as well. In continuous time with Brownian shocks, it doesn't really make sense to say you cannot lose more than a fraction of your wealth in the next dt, because Brownian shocks are super small compared to your wealth, right? So this square root here accounts for the fact that, you know, the standard deviation of the next increment of a Brownian motion is proportional heuristically to the square root of dt. That's why it has to be a square root. You can reorganize this expression using this CDF of the normal distribution into something that looks like this. There's a cap on the variance of your of your excess returns over the next dt increment. That depends on both L and alpha. Then you choose a candidate for the level of losses you are tolerant to, for example, your expected excess returns or your profits. And then you just rename alpha as an increasing function of gamma, and you get this mean variance constraint. Point is, in continuous time, setting this value at risk constraint progressively over small increments of time and choosing the right order of losses is equivalent to mean variance. Yeah?
Is it innocuous that you don't have the risk-free asset in the portfolio which you're looking at when you talk about losses?
I mean, I'm talking about the stochastic part of your returns, so it's kind of innocuous because the risk-free returns are going to be locally deterministic.
They're going to enter the expectation, right?
So this is excess returns. It is going to enter the expectation, yes. So basically, when I'm choosing this candidate level, I can play around with this.
I guess my question is, the gamma is exogenous?
Gamma is exogenous, yes.
But the risk-free rate is endogenous.
The risk-free rate is endogenous,
So
sure.
in that sense, I guess if both were exogenous, then there would probably be like a sort of kind of isomorphic, which one, whether I put it in or not, just adjusting the gamma. But given that one is endogenous,
To be honest, I'm not even sure it would be isomorphic if the risk-free was exogenous. I think if I included risk-free here, I would have to play around with gamma to get this specific expression.
right?
Yes.
Like, okay.
So it's not innocuous, yes, but this is just a heuristic explanation. This is not a microfoundation. Microfoundation is something different. Okay.
So it's very specific to value at risk. If you were want to use expected shortfall, did you try other risk measures too?
Actually not, no. The entire reason I call this value at risk is because the literature calls it value at risk, this specific type of constraint. But
some people prefer expected shortfall as risk constraint.
yes,
Would it also work?
I don't know. I haven't tried. Yes, I need to try. Yes, I need to try. Yeah.
So generally, when you think about mean variance, that is built on assumption of quadratic utility. But here you have log utility with the constraint that is mean variance, right?
Yes.
Does that put any restrictions on your utility function itself?
So for things to work out nicely as they do in 2 slides, you have to have a log here. Yes.
No, I'm just curious, like having a mean variance constraint on the log utility, does it further restricts the utility from, like, makes it more quadratic instead of log?
Okay, I think so. What it does make more quadratic is the resulting portfolios that you choose. You're going to be moving along as something like a quadratic frontier in the portfolio space because of this constraint. It's also always going to be binding as well, right? Log utility is here for the intertemporal choice mostly. So let me show you portfolios. So portfolios that come out of this are simple. Portfolios and consumption. So consumption is the typical log utility. Consumption is just proportional to your wealth. Portfolio is a typical mean variance portfolio with this time varying and stochastic risk tolerance coefficient or effective risk tolerance coefficient, right? It has to be below 1. If it's above 1, then you're kind of less risk averse than a log utility guy, so it's not binding. and you're just going to be a normal log utility agent here. So gamma has to be below 1. Okay, why is this nice? Well, this is nice because compared to the literature that existed before, this is one tiny step towards tractability. What are examples of the literature that existed before? Well, in the papers that really innovated on this value at risk constraint in finance, agents face a cap on the standard deviation of their returns or excess returns in portfolio. This also leads to a mean variance type of portfolio, but the multiplier, the effective risk tolerance, is also endogenous. It doesn't directly map into the multiplier on the constraint. It depends on other endogenous states. There's an additional step you have to take to solve for it, right? So having this is nice. Having the endogenous part here kind of complicates things a bit. You can achieve the same myopic looking portfolio by just imposing that the agents live for one period or they only care about the next period. Some super successful model, some good segmented markets models have achieved that. What they lose is the endogenous interest rate from the consumption savings decision that is just, not existent in those one period models. And then another way to get potentially different risk tolerances across agents or time-changing risk tolerances is to use recursive preferences. This is a very powerful tool. So what you're going to have with the recursive preferences, so recursive preferences are preferences that separate aggregation of utility across states from aggregation of utility across dates in the calendar. If you set the elasticity of intertemporal substitution to 1, you're still going to have this nice consumption choice. Your consumption is going to be proportional to your wealth. You're still going to have this mean variance part in your portfolio choice with potentially time-varying risk tolerance, but you're going to have additional terms in here. Those additional terms are called the hedging motive terms. They account for the correlation between returns and your marginal value of wealth. Unless your value function separates into wealth and aggregate states like it does for the log, this correlation is going to be non-zero because marginal value of wealth depends on aggregate states. And this term is going to feature some additional states that you have to follow, and this term is going to feature some additional PDEs that you have to solve, right? So potentially this term is very useful empirically. It helps you account for equity premia. It helps you account for co-movements between exchange rates and relative consumption between countries. But sometimes for the ease of computation, you want to shut it down. So here's a way to shut it down.
Aleksei?
Yep.
And in that model, in recursive preferences, is gamma t exogenous as well, or is it endogenous?
You can make it exogenous and time varying. Yes. To the extent that it's different from 1 on path, you're going to have something that depends on the marginal value of wealth, basically eta prime, and there's going to be a huge PDE to solve.
So you finance leverage in this model with at the risk-free rate, is that right?
Yes.
And the thing that gives you the separation is linear in wealth, right?
Is linear in wealth plus log utility of consumption.
But so if you think that borrowing costs are a function of net worth, then you wouldn't have separation.
Borrowing costs are...
When I take leverage, it's a function of the rate I'm charged to borrow to take leverage is a function of net worth.
Oh yes, this is illegal. No, this is outlawed. This is prohibited here, unless you do this trick that we all do sometimes. You say, well, instead of this agent with this net worth, there's this type of agent with this net worth. They're all the same. Maybe there's sharing of wealth between them, and then their borrowing costs depend on the aggregate wealth of this type of agent. Yes. Then it's going to be on every path with probability 1 the same as the wealth of this individual agent, but they're not going to internalize it. So this trick is super useful. We're going to do it too today. But except for consumption, everything here has to multiply your own wealth. Sorry, another question.
So gamma t is exogenous?
Yes.
I guess, do you have a micro foundation in mind as to where this gamma t comes from?
Yes, I do. So far, because I call it a value at risk constraint and it's exogenous, this constraint has kind of a regulatory type of vibe. You might not necessarily want that. You might not want financial crisis in your models to be caused by tightening regulation. So I have a micro foundation for this constraint through robustness concerns. So imagine a different agent doesn't have this constraint, only has log utility, but is concerned that they misspecify their model for the excess returns. And then if you let them misspecify this model in a particular way, and you make them concerned about model ambiguity, they're going to behave exactly as an agent who has this value choice constraint. And there's going to be one-to-one mappings of everything to everything. Okay, that's on the paper. I'm probably not going to have time today to show it.
Or it's like an infinite aversion to a disaster.
It doesn't even have to be infinite, yes.
Okay.
So how averse you are to disasters is going to be a parameter, is going to map to gamma. Yeah. Okay, so how else can we, sorry.
Just a clarifying question. So this constraint is about how much, what type of risk you are taking, right? And it's not about like depending on your wealth, how much risk you can take.
No, it's not that. It's how much risk you're taking per unit of wealth.
Right. But in general, when you think about portfolio constraint, it's generally about leverage and how much leverage you can take.
How much leverage you can take.
So I'm trying to rationalize like what is this presenting?
This maps, although not directly, into how much leverage you can take. Leverage is also a number, unitless, right? It's also per unit of wealth.
Yeah.
Um,
But this is rather like what kind of risk you can take given whatever your wealth is. Like you can take it, like you probably won't be able to make a very risky investment, but you will be able to take risk that is not as much risky, like the variance is less, but you are still taking accumulating risk.
yes. Yes, everyone here is able to take the same, and will take the same amount of risk in equilibrium per unit of wealth.
Yeah, so you're basically what you're saying is like I'm restricting your choice of investment rather than how much risk you are accumulating.
I don't immediately see the difference between the two. So that sounds right, but I don't immediately see that the two are different things here. I am restricting how much risk you take.
I'm saying you can take same amount of leverage,
Yes.
but make a much more risky investment.
Yes, yes.
But this is just restricting you the amount of risky investment, the type of risky investment, not the leverage you can take.
This is restricting how much risk you can take in total.
The type of risk you are taking, not the.
No, so the constraint doesn't care how you achieve this level of variance. The constraint says variance cannot be higher than something.
Variance is representative of the type of risk you are taking.
No, it's just the sum of variances over your portfolio. So, for example, the constraint could be equally binding if you take a huge position in one risky asset.
Let me put it this way. So you are taking the same amount of leverage in the sense you are borrowing the same amount, but because the investment is risky types, you are not being able to like accumulate your wealth through a particular investment. You see the difference?
Okay, let me say one thing and then I'm gonna go. So one thing is the constraint doesn't care if you take X amount of risk through just exposing yourself to one risky asset and ignoring everything else, or you take the same amount of risk by exposing yourself to a bunch of different risky assets a bit. Okay, so you can accumulate your investments in any assets you want. The constraint just says, well, the sum of those, including the correlations, cannot exceed something. When we go to equilibrium, maybe it's going to be more clear, but I kind of have to go because of time.
Maybe a quick question, feel free to refer it after. But with this robustness, like micro foundation, I could imagine that microfounds particular level of gamma. But how does it microfounds like changes in gamma?
Same ambiguity aversion parameter changes over time. Gamma changes over time, yes.
It's a preference shock.
It is a shock to preferences, yes. One last quick question. No? Okay, go. So aggregation. So why we want to use this? Why is this helpful? So let's set up an economy here and talk about the equilibrium. So the economy that I'm going to be studying is repeat the same guy n times. They're going to be different. Agents are going to be different for exogenous reasons, potentially different gammas, also potentially different over time. They're going to be different endogenously. Their wealth, they could start with different wealth, different initial conditions, and then endogenously they're going to accumulate different wealth here, W. There are k risky assets here, again, right, and one risk-free asset. I'm going to fix the supply of those risky assets so far. Maybe later we can incorporate investment as well. But now, as J's are going to be fixed, The prices of assets in equilibrium are going to be PJTs, and they pay dividends YJTs. This is as well highlighted in blue because it's exogenous. So this is the second exogenous variable in this economy, the second exogenous vector. Okay, the interest rate is endogenous, going to be determined in equilibrium. So what agents choose is they choose vectors of portfolio shares here, theta. And then to set up equilibrium, I need to tell you the positions themselves, right? Portfolio shares are how they distribute their own portfolio. I need to tell you also how much of each asset they physically hold. This is going to be denoted by H. So their holdings of the risk-free asset is the complementary holding here. Okay, so the equilibrium is a set of price processes and quantity processes where everything that is chosen optimally, and then markets clear. What markets clear? Markets for every asset, risky asset clear. Markets for the risk-free asset clears. This is in zero net supply, and then there's one consumption good. It's produced from those K risky assets. Whatever people consume has to be paid out as dividends.
So maybe I'm wrong, but as far as I understand here, if all the gammas were the same across individuals, all individuals would make the same portfolio choice. And so the gammas are clearing the market, or
the gammas are interesting. Markets would clear if everyone makes the same portfolio choice too.
Because prices adjust.
Yes.
Okay. But yeah, I mean.
Let me show you how prices adjust.
Okay, sorry.
No, don't worry. So let's characterize equilibrium, right? So what is the aggregate state in this economy? The exogenous states, dividends and gammas, and then the wealth vector, right? We need to make this wealth vector aggregate wealth, so that we need to have a wealth vector in the economy that people don't completely internalize their changing. So gammas and y's evolve as Brownian motions, as promised before. They load on different shocks, the z for the dividends and w for the gammas. Z's and w's are uncorrelated. You can make them correlated as a potential cheap calibration trick, not necessarily recommended though. Here they're going to be orthogonal. And we need to characterize the prices of risky assets and the risk-free rate. So the prices of the risk-free assets, I'm just going to define here the drift in those prices and the loadings on the two types of shocks. And the excess returns in this economy are defined as this deterministic part plus this stochastic part. So what's in the deterministic part? The deterministic part of excess returns is the drift in prices, expected capital gains, plus dividends. They're locally deterministic. You know what they're going to be in the next period, less the opportunity cost of investing this wealth into the risk-free asset. So this is on top of the risk-free. That's why it's excess returns. And this is relative to prices, right? So this is the dividend yield and capital gains yield.
Is it right to interpret that this value at risk constraint allows you to kind of substitute for heterogeneous risk aversions and also allows you aggregation, which is also time varying?
That's exactly right. Yes. Okay. Yes, the second part is those stochastic capital gains. Here, no locally stochastic dividends.
Could you remind us what is D and what are the shocks Z and W?
So the Z and W are just underlying exogenous shocks.
Okay.
Right?
And Z was the shock to X and W was the shock to what?
No, so X is like all states combined in one vector. Z is the shock specifically to dividends, to output. And W is the shock specifically to gamma. Yeah, no worries.
What was D?
Oh, yes, important. So D here is a diagonal matrix with the P's on the diagonal. Yes, sorry about that. Okay. So the excess returns that we saw before in slide 1 are this. Okay, so let's start characterizing stuff. The first important thing is that the log utility, or more specifically, the unit intertemporal elasticity of substitution, gives us very simple consumption choice. Consumption is proportional to wealth, which means in equilibrium, output is proportional to wealth, or the other way around. Total wealth is proportional to total output. So total wealth is exogenous. This simplifies things a lot. We need to define now the drift and the volatility, or sorry, the loadings of the total wealth. And you can see that the total wealth does not load on shocks that drive gamma. And this is all because of the unit intertemporal elasticity of substitution. So all these things, the drift and the volatility of, the loadings of total wealth are exogenous, only depend on the dividend. Okay, and the next important object here is the wealth shears. So because the total wealth is exogenous, what we need to follow is just the wealth shears of individual agents. I'm going to use this term, wealth shears, interchangeably with the wealth distribution because that's what it is. So I'm going to denote them by new IT. One important moment of the wealth distribution here is the wealth-weighted multiplier, value at risk multiplier. This is going to measure, in equilibrium, this is going to measure the aggregate risk tolerance. I'm going to denote this by large gamma, and it's in blue because it's important. Then another potentially important moment is, well, okay, I need to say that you kind of need to, in general, follow the entire wealth distribution here. So this model is rich enough to make you do that. But sometimes some moments are more important than others. For example, this dispersion of wealth-weighted gammas, risk tolerance multipliers. This is a variance, and this is positive. Yes?
There are no aggregate shocks which will move the heterogeneous risk aversion. Like, you know, if there's a crisis, risk aversion spikes, and it's like, there's no shifter.
That's W. That's W.
So stuff that moves around exogenously is everyone's gammas and the output, right? So what those shocks are going to do to this aggregate risk tolerance is they're going to change gammas directly. And also, potentially, they're going to redistribute between people with different gammas. So suppose they're... Yes.
It's not.
Idiosyncratic. No, aggregate shocks are going to redistribute wealth between people with different gammas.
But the gamma shocks W are idiosyncratic or aggregate?
Everything is aggregate. No idiosyncratic shocks here could make it happen. Next slide is going to show you why. Maybe not that important. Okay. Okay, results. So first of all, the leverage that agents take is how risk tolerant they are relative to the market in equilibrium. This is not following directly from portfolio choice. You need to do some aggregation here. But this is nice and simple. It just tells you you're levered up, meaning you invest in risky assets and borrow in risk-free if you are more risk tolerant than the average market participant weighted with wealth shares. For people whose gamma is low enough, they're also going to invest in risky assets potentially, but they're also going to invest a positive portion of their wealth into risk-free. Other people are going to borrow in risk-free, and then the market for the risk-free clears, zero net supply. The second proposition tells you how the wealth shares here evolve. There are a couple of things here. So one thing is, obviously, how your wealth share evolves depends on your leverage, on how much exposure to risk you take here. And this object features your own gamma, it's exogenous, and this one endogenous summary of the wealth distribution, large gamma. Only this thing makes wealth shares evolve differently across people. The other part is the same for people. So basically, your leverage determines your exposure, so how much your wealth share is drifting over time and your exposure to shocks. The second thing to note here is that wealth shares are not actually exposed to shocks to gamma. Okay, so shocks to gamma themselves are not redistributing wealth across people. This is an implication of what we, I think, talked about before. People here are essentially the same in how they value risk of different assets. So they have different total risk tolerance, but their portfolio shares within the risky part of their portfolio are going to be the same. They take the exact same exposure to risky assets, and then it scales up and down depending on their gamma. But shocks to gammas that potentially move risk premium and asset prices move everyone's portfolio, risky portfolio, in the same way. Also, they do not move aggregate wealth. That's why wealth shares are not exposed to W. Yep.
Without the budget risk constraint, the risk-free rate should satisfy the Euler equation for each of the agents for marginally the risk-free asset. with the constraint, how is the Euler equation for the risk-free rate modified?
That's next slide. Yes,
Okay.
one second. Okay, and then the third thing to note is that, well, this evolution equation is essentially exogenous, but for one moment of the wealth distribution, one endogenous thing, and this is gamma. So this is why the wealth weighted average is important here. Now let's analyze a bit how the wealth shares evolve. So first of all, if you take more leverage, meaning you're more risk tolerant, you're more exposed to aggregate shocks that move aggregate wealth, right? Of course, if aggregate wealth goes up, you're more exposed to it, so your wealth share is gonna go up. It pays off to bet on the economy if the economy grows. Second, there's a drift in the wealth share, and the sign of the drift depends on whether you are levered or under levered. Why? Because people who take on leverage more than others receive compensation for risk. This compensation for risk is locally deterministic payoffs. So if you abstract away from the realized risk, deterministically they're getting richer just because they're investing in assets that pay premia. Okay? Gamma is below 1. If your leverage is above 1, over time, on average, you're getting richer, and then this thing is gonna sometimes kill you more than others. Okay. Now, how does gamma itself evolve? So how does the market-wide risk tolerance evolve here? Well, we can also sign its exposure to Z shocks. Of course, if the economy itself is growing, people who bet on the risk, which is aggregate consumption, are getting richer. Their wealth shares increase, so the market-wide risk tolerance increases, right? This redistributes wealth to more risk-tolerant people. Second, this gamma is also drifting up over time because those same risk-tolerant people are receiving risk compensation deterministically, so they're getting richer on average as well. So this market-wide risk tolerance in general is drifting up, and then sometimes adverse shocks bring it down. Or maybe you can impose wealth taxes to bring it down. Then, of course, this weighted average is going to change if gammas change. But if gammas are fixed, you still have this part. Okay, so this is result number 3. Now going to the asset prices, this is what the interest rate in this economy looks like. It's kind of a simple expression, also only depends on one endogenous thing, this wealth-weighted average of risk tolerances. So the part that is kind of standard, I mean, all of this is kind of standard. The part that you will have if everyone is log utility is just gamma is equal to 1 and constant, right? But you're still going to have the growth term, the time discounting term, less the risk premia, the precautionary savings part. Of course, if gamma increases, this precautionary savings part shrinks, so the interest rate goes up. If gamma decreases because the market is becoming more risk averse, the interest rate goes down.
And you know, with log utility, typically you get the risk-free rate wrong if you get the equity premium right. Is there a way to calibrate gamma so that you can get both moments?
So short answer is, if you have a large enough number of assets, with just one risky asset, for example, your price dividend ratio is going to be fixed. You're going to completely miss-target equity premium, the equity premium and the low and stable, or the low and stable interest rates, one of those. And then if you open up your economy and do open economy, you're going to miss-target 15 different other things. Yes, with a large enough number of assets and with smart enough exogenous gamma shocks, perhaps. Yes. Okay, so prices of risky assets. This is a typical Bellman equation, but for the risky assets, right? The required alternative return on the risky asset has to be compensated by the dividend, the expected capital gains, less this risk adjustment. This risk adjustment is interesting because it shows you that the risk adjustment only loads on the shocks that come from dividends. So again, gamma shocks are not directly priced here because they do not change aggregate wealth. What the market here cares about is shocks that are correlated with aggregate wealth. This is an implication of the particularly easy aggregation. Everyone is the same, just scales up and down the risk tolerance. Okay, so one corollary of this is if you want to solve for asset prices, your PDEs are going to be linear, and they're going to look very simple. They're going to be what you expect. So if you have done these backward equations before, it's exactly what you usually do. You solve for the left part by taking the Jacobian of prices. The growth of the aggregate state has to be amended for this risk adjustment because those are risky assets. And then there's this second order term. So this is a second order PDE for asset prices that is linear. The fact that it's linear depends on markets being completely integrated and the value at risk constraints here. Another corollary is if you're into asset pricing, you might want to use this formula for computing the asset price as a expected discounted stream of future dividends. And there is an SDF in this economy that has a very simple form. So this SDF evolves with the usual time discounting and the growth rate of the economy rate, and the endogenous part of the evolution of the SDF only depends on one moment of the wealth distribution, this wealth-weighted average. Now, this economy doesn't have complete markets. This SDF is not unique, but it exists, and you can use it for pricing if you want to. Yeah.
In the PDE for the asset prices, how can you solve it backward? Because, I mean, where do you start? It's not like a determined snapshot of
Okay, so this is a bit of terminology. This is a bit of jargon. I apologize. So this equation is called backward because prices are forward-looking objects.
Ah, okay. Yeah.
Or value functions. This is usually solved for value functions. They're forward-looking objects. So what you typically do is you solve them backwards. You start with a terminal condition, and then you go back. If so, you guys maybe.
No, so you iterate until you converge.
Yes, but even before that, if you've done like MIT shocks, you know, you start with a terminal condition that you're back to the steady state, and then you roll it back. This is why it's called backward. There's another equation for the backward-looking objects, the distributions that evolve forward. So those equations are called forward equations. This is Kolmogorov backward equation, and those are Kolmogorov forward equations. Yeah. That's what I meant. Sorry. Now this is slightly different from an MIT shock because I'm solving this in a state space. It's not a sequence, right? But still doable. Okay. SDF. Right, 2 examples. I have 40 minutes more? Yes. No, I have 20 minutes more.
Oh, yeah.
Almost got you. Okay. Integrated markets. So 2 examples. I'm going to give you 2 examples with integrated markets. They're meant to be super simple and illustrate the 2 forces that lead to risk premium volatility. So what is the simplest possible economy where you can illustrate something that I showed you before? Well, you must have one of one thing and 2 of the other thing. So here we're going to have 2 agents and 1 asset. Then there's a converse case, 2 assets and 1 agent, right? That has been done by John Cochrane in a 2007 paper. So we're going to like slightly tweak that as well. But let's start with a recent paper by Ricardo Caballero and Alp Shimshek that has 2 agents and 1 risky asset, and 1 risk-free asset, of course. So 1 Lucas tree, think about 1 Lucas tree, 1 risk-free asset, and 2 agents with different risk aversions. So the story in this paper is kind of powerful. It shows how shocks to risk premia lead to real shocks, or I should say shocks to things that drive risk premia through asset prices lead to shocks to output. They have a New Keynesian block in their model, but the main driving force is something happens to people's preferences or the distribution of wealth across people with different risk tolerances. This moves market prices for risky assets, and this affects real outcomes. So what I'm going to show you here is a way to simplify this first part, how shocks that redistribute wealth affect market prices for risky assets. So what we're going to have is, so they have speculation in their paper, people with heterogeneous beliefs and heterogeneous risk tolerance. They make bets on the economy, bets go off, and then there's wealth redistribution. What I'm going to show you is just 2 agents with different gammas. Gammas are going to be fixed. They bet on the same Lucas tree that also gives them their aggregate consumption. Then when the Lucas tree pays off well, the guy who made a larger bet, the more risk tolerant guy, becomes relatively richer. This pushes risk premia down. This pushes the interest rates up. This is going to be end of story. There's a very closely related paper that does pretty much the same thing. Okay, so the Lucas tree I'm going to simplify now. The dividend is going to be a geometric Brownian motion. This is unfortunately non-stationary, right, to the question before. Some endogenous things in this model we can still stationarize. So two people have a gamma bar and gamma lower bar. Gamma lower bar is lower. This is a less risk-tolerant agent. Total wealth here is exogenous for the same reason as before, because of log utility. So the entire state of this economy is going to be the wealth share of, let's say, the more risk-tolerant agent, right? The entire endogenous state, and one exogenous state, the dividend. I'm going to define the wealth shares as before by calling them nus. The weighted average of the risk-tolerant levels with wealth shares is, again, this large gamma. We can just straight away plug everything into the propositions from before after the question. Yeah.
In principle, with the Lucas tree and the geometric Brownian motion for the fruit, with log utility, you can kill the fruit of the Lucas tree as a state variable, right? Because it normalizes everything.
Yeah. If you have log utility in this economy, this means you're collapsing it to a representative agent.
Okay.
And then basically just everything scales with y. Yes.
So I guess the only state is the...
In that economy, there's going to be 0 state variables.
Okay. Yeah.
But here I'm going to keep heterogeneity, and I'm going to keep away from log utility for this reason. So I need gammas.
So you don't have log utility. Okay.
No, I have log utility of consumption, or log felicity of consumption, right?
Okay.
Plus the value at risk constraint. So the same setup I showed you before, just a special case. So in this special case, the formula for the interest rate is super simple. Just the time rate of discounting, constant growth rate of the economy minus the risk premium, and the risk premium depends on the wealth share of the more risk-tolerant agent. If that increases a lot, the risk premium shrinks and the interest rate goes up. If the risk-tolerant agent becomes poor for some reason, the risk premium increases and the interest rate goes down. There's one asset, so as promised, the price-to-dividend ratio is fixed. This is very bad empirically, but this is very good mathematically. Okay, now what is the leverage they're taking here? There's a clear ranking as before, and I can also just tell you what the leverage of each agent is equal to. For the more risk-tolerant agent, regardless of the shocks before, regardless of the growth rate of the economy, they're always going to be levered. So their position in the risky asset is going to be funded by borrowing in risk-free from the other one. The less risk-tolerant agent is going to invest positively in both the Lucas tree and the risk-free asset. Okay, so it's kind of expected here that shocks to the Lucas tree are going to move the wealth distribution, or this single wealth share, in the direction wealth share of the risk-tolerant agent increases in good times, decreases in bad times. With this example, there's in fact a simple closed form solution for the dynamics of the wealth shares. The wealth share of the more risk-tolerant guy is positively exposed to this shock Z that increases the output of the economy above trend. And it's also drifting up. We can show that this risk compensation term is positive. Why? Because this agent invests more in the risky asset and then gets the risk premium. Okay. So what is the dynamics of the risk premium? Because there's only one endogenous variable in this economy, and because we make Lucas tree have a geometric Brownian motion, y just drops out of the equations. So x, the risk premium, only depends on the wealth share of the more risk-tolerant agent, and also has simple dynamics that you can solve for in closed form. You can also sign the drift of this. The risk premium drifts down because the wealth share of the more risk-tolerant agent drifts up. So over time, this economy, on average, is going to be more risk-tolerant. But then, of course, shocks that push the economy below trend, for example, are going to redistribute wealth back to the less risk-tolerant agent, and are going to raise the risk premium, and are going to decrease the interest rate. So if you think about the interest rate as a combination of price-dividend ratio and the risk premium, or a precautionary savings term, the first one here is fixed. The second one is doing all the work. Now, if you mount a new Keynesian block on top of this model, the interest rate is going to determine also your real activity, and then you can establish a feedback loop from shocks to y, to asset prices, risk premia, interest rates, and then shocks to y, if you endogenize production of y. And this is what this paper is doing here. Okay. Questions about this story? Yeah.
Correct me if I'm wrong, or remind me. So the gamma parameter could be microfounded through the optimization problem of an ambiguity averse agent. In that agent's problem, is the gamma that comes out of that independent of, say, the interest rate and risk premium in the economy, or is there a feedback loop there?
No, in that problem, it's exogenous. It maps to a different exogenous parameter that governs the strength of ambiguity aversion. Good. Okay, this economy is not stationary though. So because the geometric Brownian motion is non-stationary, here there's nothing that would potentially on average take the economy back to a medium level risk premium state. It's going to drift towards a zero risk premium and the interest rate. So the more risk tolerant agent over time with probability 1 accumulates all the wealth in this economy. If you want a stationary economy, you need to use those extensions with wealth taxes that I showed you before. So you can impose wealth taxes on people here. And then you get something like this. So if you tax people's wealth and you tax it more when the wealth share approaches 1, you can provide a force in this model that pushes you away from a state where one person is accumulating all the wealth. And you can have a stationary distribution of the wealth share in the background. It's plotted here. This is the wealth share of the more risk tolerant agent. And then you have a stationary distribution of the risk premia as well. This is why taxes could be useful for stationarizing the economy.
In equilibrium, do we have that the risk-tolerant guy is levered or not?
Yes, yes. Yes, yes, yes. So, in fact, this is the formula for their leverage.
Okay, yeah.
Their gamma is always higher than any weighted average of 2 gammas, where the other one is lower. So it's always above 1. Good. Okay, second example. So second example, 1 agent, 2 assets. What's an interesting story here? Well, 2 Lucas trees have been done before. Let's look at the bond-stock correlation. So 1 asset is going to be a Lucas tree, and the other asset is going to be a government bond. Specifically, let's make it simple. So this government bond is going to be simplified as much as possible. There's only going to be 1 representative agent, and we're going to compare an economy with and without so-called financial shocks, by which I mean shocks to gamma. So what we can show is that in this economy with 1 representative agent, when there's a claim to aggregate output, which is stock market, and a bond that pays you stable coupons with no default, if there's no shocks to gamma, then the correlation between stock and bond returns is going to be positive. I mean, conditional correlation. But then once you turn up the gamma shocks, they're going to introduce shocks to risk premia that the bonds pay over the stocks. And you can get regions in the state space where the correlation is negative. And the size of this region depends on how strong the gamma shocks is. And then it's relatively easy to solve in this model for everything in this economy. Okay. So what exactly I have in mind is the same Lucas tree as before. Let's make it geometric Brownian motion for simplicity. There's going to be an agent whose value at risk multiplier is evolving stochastically as well. If you remember, there's the Z that drives the dividends, and there's the W that drives the gamma. One trick here is to impose a specific form on the stochastic process for gamma. If you choose the volatility to be in this form and the drift to be in this form, then the invariant distribution of gamma is going to be a beta distribution with these 2 parameters, A and B. This is nice for some technical reasons. And then this 1 agent has their individual wealth, and there's an aggregate wealth in this economy. So this is a typical small k, large K trick where people think that there's their own individual wealth that does not affect excess returns, and there's aggregate wealth of the economy that does affect excess returns. They end up being the same in equilibrium, surprisingly, but agents do not internalize their own actions, how they affect the aggregate wealth here. Why we need this? To make excess returns plausibly exogenous from the agent's point of view. So the agent's budget constraint is going to be the same as before, but in this economy, I also want to have a government bond that pays you some coupons. Where does the money come from? We have to tax the agent here. So the bond is a perpetuity that pays a constant coupon. This coupon comes out of the agent's pocket, paid as a constant tax rate on wealth, and then is paid back as coupon. The aggregate state here is two exogenous variables, no wealth shares, right? Just one agent. Two exogenous variables, gamma and y. Why is wealth not an aggregate state? Well, because it's proportional to this y, to the aggregate output, for the same reasons as before. The agent is representative, and then, yes, tau looks like a wealth tax, but is actually not once you realize that these things cancel out. What is the interest rate equal to in this economy? There's again this natural interest rate part that comes from the time discounting and the growth of the economy, and then there's the risk premium. So the risk premium again depends on how risk tolerant the agent is. The risk premium decreases in gamma. If gamma goes up, you're more risk tolerant on aggregate. There's going to be less risk aversion in the market. Risk premium also depends on the composition of assets. So one of the assets is kind of safe, at least in the payouts, in the dividends, is the bond. What matters for the risk premium on the risky assets is how much of your portfolio is actually paying the same predictable return, not return, dividend over time. So the ratio of coupon to GDP, or if you multiply this by the price of the bond, this is going to be the debt to GDP ratio. Asset prices, as promised, solve linear PDEs here because the market is integrated, although not complete. They're slightly different between the bond price P and the stock price Q because of the dividend. The dividend on the bond is just the coupon. It's a perpetuity. The bond never matures, by the way. That's what the perpetuity means. The dividend on the stock is the aggregate output. The next part is just the growth part. That is very standard. It's just the Kolmogorov backward operator applied to this function with a bit of an adjustment for risk here in the drift. So it looks like the economy is growing as it does, only slightly slower because of finite risk tolerance. Okay, now this is, yeah.
If we look at the risk-free rate, it seems like it's almost like an Epstein-Sin outcome where I keep the IES equals to 1 because log, and I scale up the risk aversion, what your gamma does.
Yeah.
This is always, it's an overlap between the two. Do you know what I mean?
Yeah, I know what you mean.
That's the equivalence between Epstein-Sin and robustness constraint.
So the version of robustness concerns I'm using is not exactly equivalent. There's a slight difference. That's a good guess. So here, if we just go back, I don't remember on top of my head if Epstein-Sin with wealth heterogeneity has this in equilibrium. Does it? With a unitary IES. I need to check. If yes, it's kind of cool. Yeah. But this would be expected because the intertemporal choice should be the same. Right? Risk premium are different though. So I'm not. Yeah, there should be. I'm not completely sure if there's an expression there because I'm not sure how hedging terms feed into risk premia with Epstein-Sin or Duffy-Epstein. Yes, but I'll check. Thank you. Okay, back to the bond stock. So this is kind of, you still need to solve this numerically, but it's a two-state problem with a linear PDE, so it's kind of by now you can solve it in maybe 1/10 of a second with a reasonably large state space. One simple case though is let's shut down the financial shocks and let's just look at the bond and stock prices when there's only one shock. So everything becomes one-dimensional. There's only shock to dividends. And you can actually prove that those differential equations give you some nice properties of the bond and stock prices. So they're both increasing in the dividend. The bond price is actually increasing in a concave way. The stock price is increasing in a convex way. And then the bond price is approaching a well-defined limit that depends on gamma that you fix in this economy. And of course, the stock price goes up to become almost linear in y. Point here is that there's positive correlation between capital gains. There's always positive correlation, so you need to turn up financial shocks to get a region of negative correlation. I'm just going to show you a picture here. So this is like a fairly small volatility of gamma. You can increase the volatility of gamma to get a region where the correlation is negative. This is line where it's exactly 0. Inside it's negative, and then you increase the volatility of gamma even more. This region grows, and then you can just blow it up. So what you do here, one second, is why is the region of negative correlation here? Well, two things have to be satisfied. First, gamma has to be low enough, so you have to be afraid enough of the risk associated with the stocks. So sometimes when shocks hit you, you become more risk averse because your wealth decreases, and you value risk-free, well, relatively safer bonds more. As the price of stocks goes down, the price of bond goes up. So gamma has to be low enough, but gamma also has to be volatile enough. And with the distribution that we assumed before, here in these regions, close to the boundary, is not volatile enough.
Did you check that this story sort of matches the data? Because it is true that post-2000, the correlation went negative, and you can make the case that after 2000, there were more financial shocks or gamma shocks as opposed to pre-2000 when it was positive. I think this story is kind of reasonable.
This could be reasonable, yes. I haven't calibrated the model to the data just yet, but also this business is a bit harder than it seems because there are multiple different explanations for why the stock-bond correlation sign can change, right? I think it's a whole different paper, yes. But maybe this rings true a bit. Okay, so this is basically all I have. And I think I'm right on time, right? Questions?
Yeah. At a high level, it seems as though you've taken maybe some ingredients in a lot of asset pricing models that are entering through preferences. And then we're trying to rewrite the decision problem of an investor as having simpler preferences with an additional constraint, which affects maybe their marginal value of wealth. Because it's going to end up, there's going to be this Lagrange multiplier on this constraint. So is there like a mapping between, I guess this goes back to the questions, like is this just like a rewriting of some, like a more tractable way to rewrite some decision problems for an investor by, instead of loading it all into preferences, to do it into kind of a constraint faced by the investor?
Yeah, I think the last statement is right.
Yeah, I guess it goes back to the observation that if this does look similar to Epstein's, then it seems as though could be a cool mapping between writing things in preferences versus a constraint faced by an investor that has like a heuristic. They're log preferences, but they have some more complicated constraint that they have to satisfy.
Yes. I think that's correct. So let me just go back to this slide before here. So basically, this is an attempt at this mapping.
Yeah,
right?
exactly.
Epstein's in is going to give you, Duffy Epstein is going to give you this.
Right.
I'm killing the red term. Okay. Now there's a lot to be done here with, after you relax into market integration assumptions. Yes?
Can we go to the figure, the last figure?
The last figure.
Yeah. How will the counter moves, could you please give some definition of how the counter moves the correlation raises and decreases?
How the counter moves.
As the correlation, for example, here, correlation is 0, right? For example,
Correlation is 0 on the black line. Correlation is negative within here.
Yeah, I know. So suppose one check the counter with correlation being 1, 2, 3, 4, 5, 6. How does this counter moves?
Okay. Of course, it increases. The correlation increases as you go towards regions where gamma becomes less volatile, which is right on the boundary because it's a reflecting boundary.
How much size?
type of process. That's one thing. Another thing, it increases when you go towards higher gamma regions and when you go towards higher dividend regions as well. So, I mean, I haven't plotted other contours. You can do it. And with this model, you can do it super fast. So basically, the purpose of setting up this model is to generate these two PDEs that take a very, very short time to solve. And then there's 7, I think, parameters here that you can calibrate. So you can calibrate both, for example, the empirical path of the correlation between stocks and bonds, and you can try to do something on that counterplot. Okay. Right, so a lot of work remains to be done relaxing the market integration assumption. Segmented markets, first of all, kill the result that shocks to gamma do not redistribute wealth. And it's kind of expected, right? If you have market segmentation, some assets are only traded by subsets of people. Shocks to gammas of those people are going to change the prices of those assets and are going to redistribute wealth between them and people who do not have access to those assets. So this complicates math a lot, but this is potentially the interesting case empirically. We can talk more about, could talk more about the robustness interpretation of this. And then I think the area to apply this model is kind of large. So I'm happy to talk if you guys have ideas where you need to simplify a macrofinance model and you're ready to maybe sacrifice some empirical traction, but you want to solve something fast. Okay, thank you.